Hello traders and investors, welcome back to Hi-Tech Redneck Money. Today we're diving into the fascinating world of chart patterns. This intriguing aspect of technical analysis offers a unique lens through which we can decode the intentions behind market movements. Whether you're a seasoned trader or just dipping your toes into the financial waters, understanding these patterns can be a game changer. So buckle up as we navigate through the waves of bullish and bearish patterns that shape our trading decisions. So without further ado, let's get started. Before we jump into the patterns themselves, let's discuss why individuals search for chart patterns in the first place. You see, chart patterns are more than just lines and shapes on a graph. They are the footprints of the collective mindset of all market participants, telling a story about the tug-of-war between buyers and sellers. One of the primary intentions behind searching for chart patterns is predicting potential market movements. The idea is simple. If a particular pattern has shown a certain outcome in the past, it is likely to do so again in the future. It's like a weather forecast, but for the financial markets. Another key intention is risk management. Chart patterns can help traders identify when it might be time to enter or exit a trade, helping to manage potential losses. It's like having a map when you're exploring a new city. You might still get lost, but at least you have a better idea of where you're going. Market timing is another crucial reason why traders search for chart patterns. A well-identified pattern can provide signals about the right time to buy or sell. It's like waiting for the right moment to catch a wave when you're surfing. If you catch the wave too early or too late, you might wipe out. But if you time it just right, it's a smooth and exciting ride. Confirming trends is another important aspect. Chart patterns can help traders confirm if a current trend is likely to continue or if a new trend is about to start. It's like checking the wind direction before setting sail. You wouldn't want to sail against the wind, would you? Finally, searching for chart patterns is essential for educational purposes. The financial markets are a complex beast, and continuous learning is the only way to tame it. Understanding chart patterns is like learning the alphabet before you start writing sentences. It's a fundamental building block that can help you make sense of the market's complex movements. So, you see, searching for chart patterns is not just about finding pretty shapes on a chart. It's a carefully thought-out process with clear intentions, aimed at making informed decisions in the financial markets. Whether you're a novice or an experienced trader, continuous learning is key to staying ahead in the dynamic world of finance. Now, let's delve into some common bullish chart patterns that traders often look for to identify potential upward movements in prices. These patterns act like a roadmap, providing insight into what could potentially happen next in the market. First up is the cup and handle pattern. Just like the name suggests, this pattern resembles the shape of a teacup. The cup represents a period of consolidation where the price movement is relatively flat. This is followed by a handle, a slight downward drift, before the price breaks out upwards. This pattern is a signal that the market may be gearing up for a bullish trend after a period of consolidation. Next, we have the double bottom pattern. This one is pretty straightforward. It involves two consecutive troughs at roughly the same price level. The pattern is completed when the price breaks through the resistance level that marks the top of the previous peak. This pattern suggests a reversal of a downtrend and the beginning of an upward trend. Traders often view this as a sign that it's a good time to buy. Lastly, we have the head and shoulders pattern. Now, don't let the name fool you. This pattern doesn't indicate a trip to the hair salon. Instead, it's one of the most reliable trend reversal patterns. It's characterized by three peaks, a higher peak, the head, between two lower peaks, the shoulders. However, in this case, we're looking at the inverted head and shoulders pattern, where the head is below the shoulders, indicating a potential reversal from a bearish to a bullish trend. These are just a few examples of the common bullish chart patterns that traders and investors use to predict potential upward price movements. Recognizing these patterns can give traders a leg up in the market, helping to inform their decisions and potentially boost their profitability. But remember, chart patterns are not a surefire way to predict market movements. They should be used in conjunction with other technical analysis tools and fundamental analysis. Always do your due diligence and use sound risk management principles when trading. In our next segment, we'll talk about common bearish patterns, which are used to predict potential downtrends in the market. As you'll see, these patterns are just as important to understand, especially if you want to protect your investments during a market downturn. These are some of the common bullish chart patterns that can indicate potential upward price movements. Understanding these patterns is an essential part of technical analysis and can provide valuable insights for both traders and investors. Now let's shift our focus to some common bearish chart patterns that traders use to spot potential downward movements in prices. The first pattern we'll discuss is the double top. This pattern is a bit like a mountain range with two prominent peaks of approximately equal height. The double top forms after an extended uptrend and signifies a potential reversal. The two tops represent resistance levels where the price struggles to break through. The intervening valley is a support level. If the price breaks below this support level, it's a strong indication that a bearish reversal is in play. Next, let's talk about the descending triangle. This pattern is characterized by a horizontal support line at the bottom and a downward sloping trend line at the top. The price repeatedly bounces between these two lines, creating lower highs and equal lows. As the price continues to consolidate within this narrowing range, it builds up energy for a potential breakout. When the price breaks below the support line, it signals a potential bearish continuation. Finally, we have the bearish flag. This pattern, as its name suggests, resembles a flag, with a sharp, strong price movement forming the flagpole and a more moderate parallel trend channel forming the flag itself. The bearish flag occurs after a significant downward price movement, followed by a period of consolidation within the flag. When the price breaks out below the lower boundary of the flag, it suggests a continuation of the original downtrend. Remember, while these patterns can provide a glimpse into potential future price movements, they are not guarantees. Market conditions, news events, and other factors can disrupt these patterns at any time. As such, it's always crucial to use these patterns as part of a broader, more comprehensive trading strategy. These are some of the common bearish chart patterns that can indicate potential downward price movements. As we wrap up, it's crucial to remember that while chart patterns can be powerful tools, they are not foolproof. The world of trading is nuanced and complex, and while patterns can guide us, they don't always tell the full story. The patterns we've discussed today, from the bullish cup and handle to the bearish descending triangle, are only part of a much larger toolkit that traders use to navigate the financial markets. Understanding chart patterns is key to successful trading, but it's equally important to integrate this knowledge with other facets of market analysis. Consider factors like market conditions, news events, and other macroeconomic indicators in conjunction with these patterns to make informed decisions. In essence, chart patterns are a compass, not a map. They can guide your direction, but remember to take in the broader landscape of the financial world for a successful trading journey. Thank you for joining us today on Hi-Tech Redneck. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content.